Yes guys, so let's start the topic of AS 20, where we discuss about earnings per share. We don't see accounting for earnings per share. It's not an accounting standard. It's more of a disclosure standard that is to be complied by every enterprise. Now what kind of an enterprise are we talking about, and how many types of EPS are there, and how do we calculate such EPS, and what are the disclosure requirements is what we need to understand as a part of your AS 20. When we're discussing about this EPS, earnings per share, we have to discuss about 2 points. One is called as a basic EPS, and the other one is called as a diluted EPS. Two types of EPS being calculated. Now, understanding the applicability of this standard, basic EPS is applicable to all enterprises, while diluted EPS is only applicable for level 1 enterprises. First of all, how do I calculate this basic EPS? How do I calculate this diluted EPS? And how is the disclosure requirement and how is it disclosed as a part of your financial statements has to be understood here. So, let's talk about your earnings per share and how do I calculate this earnings per share. I'll start with the first part, that is our basic EPS. First of all, what do you understand by EPS, earnings per share? In the sense, a company earns a net profit. Now, how did the company earn net profit? On its funds invested or capital invested. So I'm saying that the capital is divided into multiple small components, and each such component is called as an equity share. Now here we want to discuss about how much is the profit that you earned per component, that is per equity share, is what we call as earnings per share. Earnings per share in the sense, you have identified the net profit. Now out of that net profit, per each component of equity, that is per equity share, how much did you earn is basic calculation of your earnings per share. Now let's try to understand what is given by this basic EPS. Basic EPS can be given by the formula PAES by WANES. In short, we call it as space by veins. Now what is this space, what is this veins? Let's understand. The numerator and the denominator part are very important to understand. The first one is PAES. Numerator part, this is nothing but profits available to equity shareholders. PAES, profits available to equity shareholders. How do I calculate this numerator, that is profits available to equity shareholder? Now normally I have a net profit. This net profit is after deduction of interest on long-term funds and short-term funds or whatever borrowing it is. So whatever profit is there, that profit should belong to my shareholders. However, that net profit which belongs to shareholder, I have two types of shareholder. One is a preference shareholder and one is an equity shareholder. Here I am very specifically talking about such profits which are available only to equity. That means my net profit belongs to both equity as well as preference. If I want to calculate only this part of equity shareholders net profit, then I'll have to deduct the preference shareholders net profit out of your entire net profit. So how do I calculate PAES? Profits available to equity shareholders is equal to net profit after tax reduced by preference dividend. Net profit after tax is nothing but your PAT calculated. After all expenses, whatever is the profit after tax, that is the resulting figure from your P&L, is what is to be considered, should be reduced by the amount of preference dividend. Now, when you're talking about the deduction of preference dividend, there are two types of preference shares that we popularly know. One such type of preference share are called as cumulative preference shares, cumulative and non-cumulative. Cumulative preference share and a non-cumulative preference share. What is the difference between a cumulative and a non-cumulative preference share? For a cumulative preference share, normally if the net profit is insufficient to pay the preference dividend, if your net profit is insufficient to pay the preference dividend, such preference dividend will be carried forward to the subsequent year. In the subsequent year, whenever you earn sufficient profits, then we pay the preference dividend out of that sufficient profits of subsequent years. So let's say year 1, I do not have sufficient profits to pay the preference dividend. So what happens? I will transfer this. I will carry forward this liability to the second year. If in second year I got sufficient enough profits, I will not deduct just the current year preference dividend, but I will also deduct that last year's preference dividend which was unpaid. That is called as a cumulative preference share. So whenever you are talking about non-cumulative, in the sense it is not carried forward. So if you do not have sufficient profits of a particular financial year, I will not pay the preference dividend. Subsequent year, if I have sufficient profits also, I'll pay only that particular year preference dividend. I will not have to pay the previous preference dividend which was not paid due to insufficient profits. This is a basic difference between a cumulative and a non-cumulative preference share. Whenever we look at a cumulative preference share, we say that a preference dividend will be deducted whether the dividend is declared or not. Because dividend is normally declared only in case of sufficient profits. If there is insufficient profits, I will not declare the dividend. But still, I will have to deduct the preference dividend, because even though you are not declaring the dividend in the current year due to insufficient profits, you will have to pay the dividend in the subsequent financial years. Now what about this non-cumulative preference shares? Whenever we deal with this non-cumulative preference share, the preference dividend has to be deducted only if dividend is declared. If it is not declared due to insufficient profits, then you don't have to deduct the preference dividend, because there is no subsequent liability to pay the preference dividend which is not paid. But here it is declared or not, I will have to give the deduction for the preference dividend. Since for a cumulative preference share, if the preference dividend for the current year is not paid in the current year due to insufficient profit, then it will be paid in the subsequent years when the enterprise earns sufficient profits. So whenever we are dealing with cumulative preference share, we have a concept called as arrears of preference dividend. Arrears of preference dividend in the sense, those preference dividend of the previous year which were not paid due to insufficient profits. Now, should I deduct this arrears of preference dividend from the profit after tax? The answer is no. Reason is, every year, whether the dividend is declared or not, I have been deducting the amount of preference dividend for cumulative preference share. So, you don't have to subsequently deduct again the arrear. Arrears are not supposed to be deducted. Arrears of preference dividend need not be deducted arrears of preference dividend need not be deducted. Now this is the concept of cumulative and non-cumulative preference shares in computation of the numerator part, that is your PAES. Now if this is the numerator, that is profits available to equity shareholders, then now I'll have to think about what is this new denominator, that is WNES, weighted average number of equity shares. How do I calculate this weighted average number of equity shares is the first question to be answered. Now, what do you understand by this weighted average number of equity shares? Weighted average number of equity shares cannot simply be said that it is number of equity shares. It is something else other than just number of equity shares. We'll have to deal with something else here. Now, how do I define this weighted average number of equity shares will be the question. So, for defining weighted average number of equity shares, he says that it is the number of equity shares outstanding at the beginning of the period. Number of equity shares outstanding at the beginning of the period adjusted by equity shares issued or equity shares bought back. So, plus equity shares issued or should be reduced by equity shares bought back. During the period multiplied by, so this complete thing is one single shot, and this should be multiplied by something called as time weighting factor. So we are talking about number of shares outstanding at the beginning of the period adjusted by the equity shares issued. Equity shares issued should be added, and equity shares bought back, which will reduce the number of equity shares, should be deducted, multiplied by something called as time weighting factor. Now, what is this time weighting factor? This time weighting factor should be defined now. This time weighting factor is nothing but number of days for which specific number of shares are outstanding during the period divided by total number of days during the period. Understand, time weighting factor is number of days for which specific number of shares are outstanding during the period as a proportion of the total number of days in the period. Now, this is basically what he is talking as far as time weighting factor is concerned. Now, observe again weighted average number of equity shares. You will understand something better now. It is the number of equity shares outstanding at the beginning of the period adjusted by equity shares issued or equity shares bought back during the period multiplied by time weighting factor. Such time weighting factor is the number of days for which specific number of shares are outstanding during the period divided by the total number of shares during the period. Let's say, for example, in computation of points, I am taking an illustration 1. Let's say, for example, on 1st Jan, I had 1800 shares. Well, on 31st May, 1800 shares, number of shares outstanding. I'm taking some random figures, guys. 31st May, let's say 600 shares were issued. on 1st November, 300 shares were bought back. And ultimately on 31st December, that is the end of the financial year, I was left out with 2,100 shares outstanding. I am giving you the information for the number of shares outstanding at the beginning of the period, the number of shares issued during the period, number of shares bought back, and the number of shares which are outstanding at the end of the period. Now, if this is the basic information given, I'll say that I can calculate your number of weighted average number of equity shares in two methods. The method 1 in computation of Vanes is simple. 1800 multiplied by 12 by 12, then plus 600 issued on 31st May. 31st May to 31st December is 7 months. 7 by 12 minus 300 shares bought back into 2 by 12 because they were bought back on 1st November, 2 months, and this should give me what is the weighted average number of equity shares. First one as it is 1800, second one should be 350 positive, and the last one should be 50 negative, leaving me with a balance of 2100. There is one way of calculating the answer. I'll also give you the second way of calculating the same answer. I am saying that 1800 shares are outstanding from 1st Jan to 31st May, 5 by 12. After 31st May, now I had issued 600 shares. 1800 plus 600, the total number of shares became 2400. How many months? From 31st May up to 1st November, another 5 months. From 1st November, they have bought back 3000 shares, so I am left out with only 2100 shares. For how many months? 2 months. Now try to calculate this part. How much is it? This is 750. This is 1000. And this is 350. Again rounding it off to 2100. Now, we have calculated the same answer by two methods, but I am here to say that there is some defect in the method that we have calculated. Just check. Now, let me start with the beginning point. Number of shares outstanding at the beginning of the period added with the number of shares issued, reduced by the number of shares bought back, multiplied by time weighting factor. Now, I said after you adjust, you need to multiply with time weighting factor, but in the first case, 1800 shares directly I multiplied with the time weighting factor, and that 600 shares issued were multiplied with their own time weighting factor. I am applying time weighting factor for every issue, every bought back and the opening which is not said. In the statement he clearly said, first adjust the number of shares with respect to the number of equity shares issued and number of shares bought back, then multiply with the time weighting factor. So method of computation in this first method is absolutely wrong. Now, apply again. Number of shares outstanding at the beginning of the period should be adjusted with the equity shares issued or equity shares bought back. 1800 shares, issued 600 shares, 2400, bought back 300 shares, 2100, absolutely right. Absolutely right in computing the number of equity shares multiplied by time weighting factor. Absolutely, I multiplied it with the time weighting factor for the number of shares for number of days for which the specific number of shares are outstanding during the period. 1800 shares were outstanding for 5 months out of total 12 months, divided by total number of days or total number of months. Guys, we have been using number of days here, but then I have been using number of months. However, though I am saying that this calculation is not right as per the part of the standard, I'll say that still 2100 is absolutely right. I'm saying your time weighting factors are wrong because you need to calculate a number of days. However, I have come up to the statement saying that my 2100 is absolutely right because he has added one statement saying that a reliable estimate of weighted average number of equity shares, that is Vanes, is sufficient in many circumstances. Guys, it's a reliable estimate, guys. It's a reasonable estimate that we can get. Even if you take number of days, you will be landing out with some answer which is pretty close to 2100. Which is very, very close to 2100. Now, this is the first part of what we talk about weighted average number of equity shares. Take down the illustration and also solve it. Clearly write down that the first method is wrong and the second method was correct as far as the number of shares are concerned, but not with the time weighting factors, because the time weighting factors accordingly should be number of days and not the number of months. But however, we said the final answer is absolutely right, since it only asks for a reasonable estimate or reliable estimate. I don't need a perfect answer there. Yes guys, if you are done with this, then we'll have to think about what are the adjustment to weighted average number of equity shares. Well, weighted average number of equity shares computation is not as simple as what we have seen till now in the computation. There are few adjustments to weighted average number of equity shares that we have to think about. What are these? My adjustment to weighted average number of equity shares we'll have to think about three parts. First one is partly paid up shares or shares with different nominal values. My second part, another adjustment to weights is change in number of shares without corresponding change in enterprise resources and the last and final one is adjustments with respect to rights issue. These are the three adjustments in weighted average number of equity shares which we have to understand. Where a partly paid share or shares with different nominal value, shares with different nominal value in the sense variable rights. So one share is 10 rupees, other share has a face value of only 8 rupees, another share has only a face value of 5 rupees. So they are called as shares of different nominal value. Change in number of equity shares without corresponding change in our enterprise resources, we'll have to think about that. Last one is the rights issue. Let's start with the first part, that is partly paid shares and shares with different nominal value. I'll start with the first adjustment. Partly paid up shares and shares with different nominal values. Now let's see what do we do with this. For example, let's say I have equity shares like this. My share capital consists of equity shares this way. I have 10,000 shares of 10 rupees each, fully paid up. And I have 8,000 shares of 10 rupees each, 5 paid up. I have 6,000 shares of 5 rupees each, fully paid up. And I also have 5,000 shares of rupee 5, of which only 4 is paid up. Now this is my total consisting share capital. I have shares with nominal value of 10 as well as 5. Two nominal values existing. Such 10 rupee share is fully paid up, or such 10 rupee share is 5 paid up. Or I can have a 5 rupee share which is fully paid up, or a 5 rupee share which is 4 paid up. Now if this type of a question is given to me, if I have to calculate weighted average number of equity shares, let us assume that there is no equity shares issued or no equity shares bought back. These shares were at the beginning and at the end you have the same equity share capital. In such case, how do I calculate my weighted average number of equity shares? Simple situation. When you have such share capital, he'll say that weighted average number of equity shares should be based on equivalent number of shares. Equivalent number of equity shares. In a simpler sense to put this, what is this equivalent number of equity shares? I'll come up with this. When you calculate EPS of rupee, let's say I'll say rupee X shares. Rupee X share fully paid up is equal to PAS divided by weighted average number of equity shares variance of rupee X fully paid shares. Now, how do I get this denominator part, weighted average number of equity shares of rupees X each fully paid up? Variance of rupees X fully paid up is equal to total paid up share capital divided by X. So if I want weighted average number of equity shares of rupees 10 each fully paid up, then I will do total paid up share capital divided by 10. If I want weighted average number of equity shares of rupees 5 fully paid up, then I'll say total paid up equity share capital divided by 5. What is the total paid up equity share capital? Everything put together, this is 1 lakh paid up share capital. This is 40,000, 8,000 shares of 5 rupees each, 6,000 shares of 5 rupees each is 30,000, 5,000 shares of 4 rupees each is 20,000. This is probably about 1,90,000. In total, this is 1,90,000. This is the total paid up share capital. So, if I want weighted average number of equity shares of rupees 10 each fully paid up, then it is simple. Total paid up share capital is 1,90,000 divided by 10. So equivalent number of shares to be considered as variance is only 19,000. If I want weighted average number of equity shares of 5 rupees each, then 1,90,000 divided by 5, number of equity shares will become 38,000. This is how we calculate weighted average number of equity shares in case of partly paid shares or shares with different nominal value. Both the cases I have a single treatment, that is to adopt equivalent number of equity shares. To calculate equivalent number of equity shares, I am giving you a formula, that is EPS of weighted average number of equity shares of rupees X each fully paid up is the total paid up share capital divided by X. This is the formula to be adopted in calculating variance when I have different paid up share capitals and different shares of different nominal values. This is the first adjustment. My second adjustment was with respect to change in number of shares without corresponding change in enterprise resources. We'll think about this. Observe carefully, guys. Change in number of shares without corresponding change in enterprise resources. What is this change in number of equity shares without corresponding change in enterprise resources? Now, what is an enterprise resource? This word enterprise resource is nothing but net assets of an enterprise. Net assets of enterprise. If let's say shares were issued for consideration in cash, I collected cash, I issued equity shares. Number of equity shares increases, correspondingly what increases? Cash also increases. Cash is a part of net asset, so even net assets increases. So always there is a number of equity shares increase, correspondingly I'll also have an increase in the number of, in your net assets as well. Let's say I have purchased an asset for which I issued equity shares. So what is happening? Two things. One, asset is coming into the business, I am issuing equity shares. Increase in number of equity shares, also an increase in net assets, because your assets will form part of your net asset again. So that asset acquired should also be included as a part of net asset. So net assets increases, number of equity shares also increases. So this is exactly what we are talking about. Let's say a loan is repaid. Such loan, instead of repayment, they got converted into equity shares. So loan is repaid, loan reduces. Loan is a liability, liability reduces, net assets increases, increase in number of equity shares. Like this, take any particular example, you will find that when there is a change in number of equity shares, there will be definitely a change as a part of your net assets. Or here we are calling it as enterprise resource. However, then what of this thing which we are saying that there is no corresponding change? For example, share split. Reverse split, bonus shares, share split. For every 1 10 rupee share, I'll give you 5 2 rupee shares. Instead of having 1 10 rupee share, I'll give you 5 2 rupee share. There's no increase in your valuation, there's no increase in my share capital. But the number of shares changed. Only I'm talking about number of shares changed, not the share capital change. Number of shares changed. Because for 1 10 rupee share, I am giving you 5 2 rupee shares, obviously your number of equity shares will increase. Reverse split, in the sense exactly ulta. I have 10 10 rupee shares, I will consolidate them into 100 rupee share. That is called as reverse split or consolidation of shares. Bonus, capitalization of reserve. Reserve reduces, there will be an increase in your share capital. Guys, reserve was not a part of your net asset. Net assets is only assets minus outside liabilities and not the reserves. So your net assets did not change, only your reserves went down and your equity share capital increased as a part of your bonus shares when the bonus shares are issued. What is the adjustment that we are talking about? It says that in such case, the change in equity shares should be assumed to have occurred at the beginning of earliest period reported. Read through that sentence again, very, very important. In such case, which case? Where there is a change in number of shares without corresponding change in enterprise resource, then we are saying such change in equity shares should be assumed as if it occurred at the beginning of the earliest period reported. Now what is this occurred at the beginning of earliest period reported? Pretty simple, guys. Let's take a situation like this. My reporting period is 1st April 2015 up to 31st March 2016. There was a bonus issued, bonus shares issued. Let's say this date was on 1st Jan 2016. What did I say? I said, when there is a bonus is nothing but change in number of shares without corresponding change in enterprise resource, then such change, that means such bonus shares should be assumed as if they have been issued at the beginning of earliest period reported. That means even though the shares have been issued on 1st Jan 2016, I will assume that such bonus shares were existing even on 1/4/2015. I will assume that such bonus shares existed even on 1/4/2015, that is the beginning of earliest period reported, and this statement is 100% false. No. Read again carefully. Such change in equity shares should have been assumed to have occurred at the beginning of earliest period reported. Earliest period reported is not 1/4/2015, because always financial statements are prepared on a comparative basis. So 1/4/2014 should also be there on a comparative basis. I'll also give 14-15 comparatives. So what is the earliest period reported? Is it 15-16 or 14-15? Earliest period is 14-15, not 15-16. Even 14-15 is reported along with 15-16. So earliest period reported is 14-15. And for 14-15, beginning of earliest period reported. What is this beginning of earliest period reported? If 14-15 is the earlier financial year, beginning is 1/4/2014, such bonus will be assumed to have been issued on 1/4/2014. Even if you say that the bonus shares were issued on 30th March 2016, I will assume that such bonus have been issued on 1/4/2014 itself. Whatever it is, whenever it is slightly confusing, let's not understand as it is. Let us think about in depth. Why is it so? Why should I assume that these bonus shares were issued at the beginning of earliest period reported? There should be a logical reasoning for it. I'll give you the logical reason. Let's have comparatives this way. Current year and previous year. Profits available to equity shareholders, 90,000 and 90,000 each. There's no change. My weighted average number of equity shares, here it was 6,000. But here it was not 6,000. 6,000 plus 1:2 bonus was issued, that is 3,000 was given by way of bonus. So I will take the number of shares, weighted average number of equity shares as 9,000. If I am not observing this, if I am not adopting this particular scheme, then what is the impact? Check the EPS now. EPS is 15 year but only 10 year. If I report the same to the investor or the user of the financial statements, what is that very misleading in that? If any investor looks at that, he will say that my earnings per share in the previous year were 15. For every share I got 15 rupees. But current year I am getting only 10. That means there is a reduction in the value or earnings per equity share. Is that the truth? Check your net profit. Your profits available to equity shareholder was same. Is there any new shares issued? I did not issue any share for consideration in cash. It was a bonus share which is issued. So we say that these two are not comparable. Then what do we do? To make it comparable, we need to adopt this scheme. That means such bonus shares should have been assumed to have occurred at the beginning of earliest period reported. So this 3,000 rupee bonus shares issued in 15-16 should be assumed to have been issued at the beginning of 14-15. 14-15 beginning is 1st April 2014. So let's see what happens. So my PAS will remain as it is. I'm not changing the PAS. But my weighted average number of equity shares is not 6,000. The 6,000 should be added with the amount of bonus of 3,000. We'll assume that they have been issued at the beginning of earliest period reported. So we will have to add the 3,000 bonus shares in both respect. So now check your EPS. Now check my EPS to be reported, 10 and 10. Definitely I will say that these are comparable. They are comparable EPS. Take down that small calculation, guys. That is probably the reason, or should be the reason behind giving that statement, assuming that such change in equity shares, a change in number of equity shares is assumed to have occurred at the beginning of earliest period reported. So with that we come to the end of the second adjustment, guys. We have seen total 3 adjustments. So we have to talk about the third one. That is rights issue. How do we adjust for a rights issue in computation of gains? What is that peculiar point that I'll have to discuss about rights issue to understand in this question? We'll see that, guys. Why is it so special to understand a rights issue problem? Logic is pretty simple. Now what is the adjustment for right in your computation of weights? He said that there is a bonus element in rights issue. What is that? Bonus element. Now what is that bonus element in rights? Let's try to think about it. I'm giving you some random example. This is not the way you solve the problems on rights issue, but still, to understand the logic, I'm putting up like this. We know always that the rights exercise price, is always less than market price. And this is compulsory. Otherwise, there is no point of issuing a right as well. Now, observing the same principle, let's say number of rights are about 1 lakh with an exercise price per right is, let's say, about 15 rupees. And the market price per share on that day was 20, let's say. So I'm issuing each share at 15 when the market price of share was 20. So let's think about it. What are the proceeds from rights? My proceeds from rights are multiply 1 lakh rights. Each one is yielding 15 rupees. So it will yield him 15 lakhs from sale of rights. But guys, each share is allotted at 20. So market price per share is 20. So to collect 15 lakhs, if the share is issued at market price, number of shares at market price per share is equal to 75,000. That means it would have been sufficient to issue 75,000 shares at market price to get the same proceeds what you got from issue of 1 lakh shares or 1 lakh rights. So he'll say that out of my rights, what was the amount of right? 1 lakh. I am saying that 75,000 are shares issued at full consideration and 25,000 are shares issued at nil consideration. Now your shares issued for zero consideration is nothing but the bonus element. This is the bonus element in rights. The bonus element in right is that 25,000 shares which are assumed to be issued for nil consideration as a part of rights. So out of the total rights issue of 1 lakh, I am saying that 75,000 shares are issued for full consideration and balance 25,000 are issued for zero consideration. That is what we talk about the bonus element. And whenever we have a bonus, we have just seen the adjustment, we will assume that such shares have been issued at the beginning of earliest period reported. At the beginning of earliest period reported. Let's see. What do we have to deal with this here? But we don't solve the problem by this method. This is only for your understanding I have given it. But how do we actually solve the problem on rights issue? Say that bonus element is equal to RAF minus 1 into number of shares outstanding at the beginning of year. This is the bonus element in rights. What is this RAF? RAF is nothing but rights adjustment factor. What is called as RAF. How do I calculate? RAF is equal to number of shares prior rights into fair value per share prior rights plus proceeds from rights issue whole divided by number of equity shares post rights. Post rights is nothing but number of shares prior rights plus rights issue shares. I'm sorry guys, one second. This is not RAF guys. This is called as theoretical X rights price per share. This is called as theoretical X rights price per share. Now the question should arise, you were supposed to calculate RAF. From where did you bring in this formula for theoretical X rights price? Where did I use this formula? I'll tell you. RAF is equal to fair value per share prior rights divided by theoretical X rights price. Just check both the formulas guys. One is RAF, one is theoretical X rights price. You need both for computation of your bonus elements and rights issue. Let's take an example and let's try to understand this. Let us say my PAES is about 1 crore. Weighted average number of equity shares at the beginning of the year is 5 lakhs. Rights at the rate of 1:5. That is nothing but 1 lakh at an exercise price of 15. My fair value prior rights is 21. From this information given, if I have to calculate what is your EPS, let's see what we do. We need to calculate RAF. RAF is fair value prior rights, which is already given 21, divided by theoretical extra rights price, not given. We have to calculate. Theoretical X rights price. Theoretical X rights price is number of equity shares prior rights. What is the number of equity shares prior rights? Before rights, it was 5 lakh shares. Into fair value per share prior right, 21. Plus proceeds from rights, 1 lakh shares at 15 rupees. Divided by number of shares post rights. Post rights issue, how many shares? 5 lakh plus 1 lakh. I'll have total of 6 lakhs. Applying this formula, you get a theoretical X rights price of 20. If I put up my formula into RAF, fair value prior right divided by theoretical X rights price. Fair value prior right is 21, theoretical X rights price is 20. Now this is 1.05. So this is 1.05. Now, how do I identify the shares issued for nil consideration? What is the bonus element of rights issue? Let's see. My bonus element in right is equal to, we already have the formula, RAF 1.05 minus 1 into number of shares at the beginning of the period, 5 lakhs. Nothing but 25,000. I'll assume that this 25,000 shares were issued at the beginning of earliest period reported. So, when I calculate my WNES now, Vanes, this 25,000 should be assumed as if they were issued at the beginning of earliest period reported. Let's say the rights issue was given on the day of, let's say the 6 months period. Issued after 6 months. So until 6 months I had 5,25,000 shares. I'm assuming that these 25,000 shares were issued at the beginning of the reporting period itself. Plus, after the rights issue, I totally have 6 lakh shares. This 562,500 is Vanes. If this is the Vanes, then my EPS, basic EPS is equal to 1 crore divided by 5,62,500, whatever is the EPS value. This is how you calculate when the rights are given, because we calculate what is the bonus element in the rights issue. Yes guys, this is all we have for computation of basic EPS. So we have seen the numerator and the denominator part, and we had 3 adjustments as well. Now we'll have to think about the second part of EPS that we said is called as diluted EPS. What is this diluted EPS that we'll have to discuss about? My diluted EPS is nothing but the worst case EPS. I'm repeating this. I'm saying in a reasonable sentence. This is not as per the standard. For our understanding, I'm saying that diluted EPS is the worst case EPS which can be reported. Why will your EPS become worst? First question that any person will get is, why will my EPS get worse? I have this particular EPS which is reported, then why will I say that there's a worst EPS? Basically, sometimes there might be some shares, liabilities in a company which are called as potential equity shares. What are the potential equity shares? Potential equity shares are not shares. Today, they are not in the form of equity shares, but they have a right which can get converted into an equity share. So if someone gets converted into an equity share, what happens to your EPS computation? Your denominator increases. Once your denominator increases, automatically there will be a fall in your value of EPS. Now, we are trying to report to the investor that even if all the potential equity shares get converted to equity share, the worst EPS that can be reported to you is your diluted EPS. That means your EPS cannot fall below your diluted EPS. Let's see what it means. In calculating my diluted EPS, simple calculation guys, your DEPS is equal to pace plus increase in pace divided by veins plus increase in veins. First question arises, why will your pace and veins increase? My pace and veins will increase because of potential equity shares. What are these potential equity shares? Potential equity shares are contracts which entitle the holder to equity shares in future. Today they are not equity shares, but they have an entitlement, they have a right to get converted into equity share in future. Examples are convertible debentures or even your convertible preference shares, options issued by company. All these are basically my potential equity shares. For any potential equity share, we need to think about one small factor that is called as dilution. Dilution of a potential equity share think about it, is increase in pace by increase in veins. This is my dilution for any potential equity share. Any potential equity share, the dilution can be explained as increase in pace by increase in veins. Now, I said when there is conversion into an equity share, your denominator increases, absolutely correct. But even numerator increases. Yes. Let's take a case of dilution for convertible debentures. When you have a convertible debenture, guys, what happens? Debenture carries interest. But such debenture interest, after the debentures get converted into equity share, is that interest still payable? Not necessary. Because they are not a debenture anymore, they have got converted themselves into a equity share today. So you are saving in the interest that will increase your pays, but you are issuing equity share that will increase your gains. So I'll say, this is debenture interest. Guys, profits available to equity shareholder is after tax. Debenture interest is before tax. So adjust for tax into 1 minus T divided by number of shares issued on conversion. Then what about convertible preference shares? This also similar impact, guys. Convertible preference shares. In the case of convertible preference share, what is the increase in pays? How did you calculate pays? Profit after tax minus preference dividend. If preference share itself is not there, why will I pay preference dividend? So increase in pays is your preference dividend. Divided by number of shares issued on conversion. I'm also talking about options as one of the potential equity share. In the case of option, what is the increase in pays? Nothing. Divided by shares issued on exercise of options. Shares issued on exercise of options, 0 divided by anything is always 0. Always remember, guys, when your dilution, that is a dilution factor denoted by increase in pays by increase in gains, if this is lower, the dilution impact is higher. Lower this dilution, higher the impact on dilution. Now, that concept we'll understand later on, but coming to your options part of it. Whenever you're talking about dilution of option, dilution of EPS for options, we say that the dilution impact that is increase in pays by increase in gains should only be given as 0 divided by number of equity shares issued on exercise for nil consideration. Now, what is this nil consideration that we have to talk about? What is this nil consideration? Pretty simple. Let's say my profits available to equity shareholder is 10 lakhs and my weighted average number of equity shares is 2 lakhs. Using these two information, I'll say that the basic EPS is basically 5. Let's say, for talking about options, I have number of options are basically about 50,000, each one carrying an exercise price of about 20 rupees. If the market price per share on the same day was 25. Then I'll say that number of equity shares issued on exercise of option for nil consideration is equal to number of options minus proceeds from exercise of option divided by market price per share. Remember this formula, very important for options. Number of equity shares issued on exercise of option for nil consideration is equal to number of options minus proceeds from exercise of option divided by market price per share. If you want, you can apply in the given formula. Apply. Number of options is equal to total 50,000 minus proceeds from exercise of options. 50,000 options, each one exercised at 20 rupees divided by market price 25. So this will be 50,000 minus 40,000. So your dilution will only be calculated based on 10,000. So in this case, I'll say that the diluted EPS, DEPS is equal to pace plus increase in pace divided by veins plus increase in veins. Check what is pace? 10 lakhs plus increase in pace. There will not be an increase in pace in case of options. Veins already existing 2 lakhs. Increase in veins. Don't take the entire 50,000 options. I'll only take 10,000 options which are issued for nil consideration. Which are issued for nil consideration. So 10 lakh by 2 lakh 20 should be less than 5. That is what we are saying. There's a dilution. There's a dilution between your basic EPS and the diluted EPS. Dilution is nothing but reduction. So your basic EPS is always reduced in case of potential equity shares, and such reduced EPS is called as diluted EPS. Taking down that entire valuation, guys, very important. Understand the valuation step by step. I'll extend the concept a slightly more by guys from here, because here we're not talking about one single potential equity share. What if I have multiple potential equity shares, and how do I deal with this multiple potential equity shares? I'll take up this concept of multiple potential equity shares from here. Shares issued on exercise of options for nil consideration. I'm just adding those terms there. Yep. Now we are talking about multiple potential equity shares. When there are multiple potential equity shares, then how do I handle it? That means an enterprise, while presenting its balance sheet, I observe that there are convertible debentures, there are convertible preference shares, there is also options. All the three combinedly coexist in an enterprise. Then in such cases, how do I calculate a potential equity share, or how do I calculate a diluted EPS? So the dilution or diluted EPS given by this formula is not so simple. Now, remember, let's go with the steps. First one, compute dilution of each potential equity share. Compute dilution of each potential equity share. Dilution is nothing but, how do I calculate dilution? Increase in pays by increase in veins. This you calculate for each potential equity share. Rank potential equity shares in the order of dilution impact. How do I give the dilution impact? Lower your dilution, higher is your impact on dilution. Lower of step 1, higher is your dilution on EPS. Now, third one, compute diluted EPS, DEPS, using your formula, pays plus increase in pays by veins by plus increase in veins. A formula I have already given you. Using this formula, calculate your diluted EPS. Cumulating the impact of each potential equity share. Based on dilution impact rankings. This rankings were given in step 2. Calculate diluted EPS using that formula, cumulating the impact of each potential equity shares based on the dilution impact rankings given in step 2. Now this is how I calculate. Now what do I choose? The DEPS to be reported, DEPS to be reported is equal to worst EPS, or I'll say it is the lowest EPS in step 3. In step 3, whatever is your lowest EPS will be used for computation of, will be reported as diluted EPS. Take down the steps, guys, very carefully, which is very, very important, guys. Let's understand this with the help of an example. I'm taking a random example, guys. I'm saying that, let's say my PACE, profits available to equity shares, is 1 lakh. With my VANES, weighted average number of equity shares, is 20,000. Using these two, I can calculate my basic EPS, and I'll say that this basic EPS is 5. Along with that, I'm also giving you some other things, that is your potential equity shares details. Potential equity shares. Giving your details of potential equity shares, I say, first I have options. My number of options are 1000. My number of options are 1000 at an exercise price of 60. Second, I have convertible preference shares of rupees 8 lakhs. Let's say these are 10%, guys. %, convertible preference shares of 8 lakhs. Let's say it is only 8,000. Of 8,000. Convertible into 2 shares per preference share. Let's say along with that I have convertible debentures. Point number C. My convertible debentures are 10 lakhs. Let's keep this as rupee 8 lakhs only. Yep. Yeah. So convertible debentures of rupees 10 lakhs. Each convertible into equity shares of 4 each. And these debentures were carrying an interest of, let's say, about 12%. If I say the taxation percentage is 30%, and the fair value per share is 75. Let's deal with this question now. I have 3 potential equity shares. I'm giving you the tax percentage and the fair value. First, to get the options, what do I need? I need equity shares to be exercised for nil consideration. Come on, let's find out that. Shares issued for nil consideration on exercise of options. Let's check. On exercise of options, shares issued for nil consideration. Check guys once. Now, I'm saying that each option has an exercise price of 60. So, I have 1000 options minus proceeds from issue of option is 1000 into 60 divided by 75. 1000 into 60 divided by 75. That will give you the shares issued or options issued for nil consideration. Now, this is how much? This is 1000 minus 800. That is 200. 200 are the shares issued for nil consideration in case of options. So, let's see dilution. Dilution of potential equity shares. Let's see, go on. First one, options. For dilution, you need to use the formula increase in pace by increase in veins. Options, increase in pace is 0, increase in veins is 200, 0. Next, convertible preference shares. Increase in pace by increase in veins. What is the increase in pace? It is a 10% preference share of 8 lakhs. Preference dividend is 80,000 divided by each preference share. Let's say it is 100 rupee preference share. Each preference share is convertible into 2 equity shares. So 8,000 into 2. This is nothing but 80,000 divided by 16,000. Then for convertible preference shares, for convertible debentures, each debenture has a face value of 100 again. So 12% of 10 lakhs is 1,20,000 into 1 minus tax, 1 minus 30% tax divided by each one carries 4 equity shares, so 10 lakhs, each is 100 rupees, so 10,000 into 4. So this will be giving me 1,20,000 into 70% is 84,000 divided by 40,000. 84,000 divided by 40,000 will give me an answer of 2.1. Now once you have the dilution impacts with you or the dilutions with you, now you need to rank it. Rank the potential equity shares in the order of dilution impact. Lower of step 1, higher dilution. Which one is the lowest? 0 obviously. So I'll have to rank it. This will carry a rank of 1. What is the second least? 2.1. This will carry a rank of 2 and 5 will carry a rank of 3. Obviously that is the only thing left out. Now I have ranked it. Now what is your step 3? Calculation of diluted EPS. Let us see how do we calculate in this. I am using that entire example and I am trying to calculate what is the diluted EPS there. Check. I am using the formula DEPS is equal to pace plus increase in pace divided by veins plus increase in veins. Let's calculate. First, basic EPS we know. Basic EPS is equal to, you know that is 1 lakh divided by 20,000 This is nothing but 5. First, on conversion of, what is the rank number 1? First, I'll take options. Cumulative impact I have to take. So, pays plus increase in pays 0. Veins plus increase in veins 200. Check what is the impact. You will get obviously something which is less than 5. That is for sure. 1 lakh divided by 20,200. This will be 4.95. On conversion of point number 2, what is the second rank? Second rank is convertible debentures. My convertible debentures, I have to give a cumulative impact. So 1 lakh plus 0, which is for options, plus what is the numerator for convertible debentures? 84,000 divided by 20,000 already veins, plus increase in veins for options 200, plus again increase in veins for debentures are 40,000. So 1,84,000 divided by 60,200, and this will give me answer of 3.056. Now what about on conversion of preference shares? For convertible preference shares, then what do you do? For a convertible preference share, already existing pays 1 lakh plus 0 increase in pays for options plus 84,000 cumulative impact, first for debentures, then the last one for preference shares, it was 80,000 divided by veins, come on, 20,000 already existing veins plus 200 on conversion of options plus 40,000 on conversion of debentures plus 16,000 on conversion of preference shares. So that will give you basically 2,64,000 divided by, and this total is 76,200, and this will give me an answer of 3.46. Have you observed something? Initially from 5 to 4.95 there's a decrease in the EPS. From 4.95 to 3.056 there is a decrease in the EPS. But from 3.056 to 3.46 there is an increase in the EPS. This increase in the EPS is called as anti-dilutive effect. Guys, what is your main concept of diluted EPS? Worst case EPS. That means your EPS can't go beyond this. I can't report 3.46 because there can be a lower EPS of 3.056. So what is to be reported is the lowest EPS. So diluted EPS to be reported is equal to 3.056. There is nothing but lower of above. Least of the above should be reported. EPS to be reported is the worst EPS or the lowest EPS of step 3. Yes guys, then a question arises as to where to disclose. Yes, we don't have accounting for this. We only disclose an EPS. Then where do I disclose an EPS? Very simple guys. Your EPS has to be disclosed on the face of the P&L. What does it mean? That means both my basic EPS as well as our diluted EPS should be written exactly below your net profit. You calculated your net profit. There is some appropriation which is done. And exactly between you need to place what is your amount of EPS, basic as well as diluted for both previous year as well as current year on a comparative basis. However, an additional disclosure is necessary for the numerator computation, that is PAES, profits available to equity shareholders, and for the denominator, that is weighted average number of equity shares. The computation of this numerator and denominator should form part of your notes to accounts. So, what am I saying? Your basic and diluted EPS should be reported on the face of the P&L, but your computations of numerator and denominator, that is profits available to equity shareholder and weighted average number of equity share, this should be presented in your notes to accounts. This is your disclosures necessary for AS 20. With that, we come to the end of the standard, guys. That will bring us to the end of the standard AS 20.